580. That is not a failing grade. It is not a warning label. It is a pricing tier. And the institution on the other side of the counter already knows which one you are in. Here is what nobody tells you about the credit score. It is not a reputation number. It is not a signal of whether you are a good person or a careful person or a person who deserves things. It is a band assignment, a tier. And every institution that quotes you a rate, approves your application, or sets your deposit has already run your number before you walked in. The price they return to you is not the price. It is your price. The number is visible. The pricing table behind it is not. 580. You are at the leasing office. Not the apartment itself, the office, the small room with the copier against the wall and the laminated floor plan taped to the window. The manager is pleasant. The unit is available. The application went through. Then she turns to the copier. The machine runs for a few seconds. She hands you a one-page addendum. You scan it. There is a line near the bottom. Security deposit. 3 months. Not 1. 3. You were not rejected. You were repriced. The difference between 1 month and 3 months on a $1,400 a month apartment is $2,800. That money does not disappear. It sits in an account you cannot touch for the length of the lease. It earns nothing for you. It earns nothing for the landlord either, but the landlord did not need it to earn anything. The landlord needed it as a hedge. Against you. Against the tier you are in. You sign the addendum. You move in. The apartment is fine. The unit is what you wanted. The $2,800 is just gone from your liquidity for a year, maybe 2, maybe longer if you renew. That is the 580 tier. Not rejection. Repricing. 650. The score moved. You paid on time for 8 months. The balance came down. The number climbed from 580 to somewhere in the low 650s, and you felt it. Not dramatically, but you felt it. The applications stopped coming back with addendums. The rejections slowed. You need a car. Not a luxury car. A reliable car. A used sedan with 34,000 miles and a clean title. The dealership has financing. The sign outside says the rate starts at 5.9%. You sit down at the financing desk. The manager pulls up the screen, runs the application, and slides a printed disclosure across the desk. The rate on the page is 7.9%. Not 5.9. 7.9. On a $19,400 loan over 60 months. The difference between 5.9% and 7.9% is not enormous in any single month. At 5.9%, the payment is roughly $374. At 7.9%, it is roughly $392. $18 a month. But $18 a month over 60 months is $1,080. That is the cost of the tier. Not the car. Not the insurance. Not the gas. Just the tier. Just the 2 percentage points between the sign outside and the number on the page. You sign the disclosure. You drive the car home. The car is fine. The car is what you needed. The $1,080 is just the price of being in the 650 band instead of the 720 band. You did not know there was a price for that. There is always a price for that. 700. The score is in the low 700s now. This took time. Not years of perfect behavior, just consistent behavior. On-time payments. A balance that stayed below 30% of the available limit. Nothing dramatic. The number climbed because the inputs climbed. At 700, the rejections are mostly gone. The addendums are mostly gone. The applications go through. You are, by most measures, in the acceptable range. You are at the pharmacy counter on a Tuesday afternoon, waiting for a prescription. Your phone lights up. It is an email from your insurance carrier. Annual renewal notice. Same coverage. Same vehicle. Same address. The premium is $112 higher than last year. You read the email twice. Nothing changed. Not the car, not the coverage, not the driving record. The renewal letter does not explain the increase in detail. It rarely does. What it does not say, what it almost never says, is that in most U.S. states, insurers use a credit-based insurance score alongside your driving record when setting premiums. The credit-based insurance score is not identical to your FICO score, but it is built from the same underlying data, and it moves in the same direction. At 700, you are not in the penalty tier. You are in the middle tier. The middle tier still pays more than the top tier. Not catastrophically more, just persistently more. Every year. $112 more this year. Probably similar next year. The math does not grade on loyalty. You put the phone in your pocket. The prescription is ready. You pay for it and leave. The $112 is not a crisis. It is just a number that arrived while you were doing something else, and it will arrive again next year, and the year after that, until the tier moves. 750. The score crossed 750 sometime in the last 6 months. You did not do anything specific to cross it. You kept doing what you were doing. The number moved because time moved and the inputs held. You are at the title company. The closing table. The mortgage commitment letter is in front of you. A stack of documents, tabbed with colored stickers, each one waiting for a signature or an initial. The rate on the commitment letter is 6.625%. A colleague mentioned last week that her rate came in at 7.125%. Same loan type, same term, same lender, different tier. The difference between 6.625 and 7.125 on a $280,000 30-year mortgage is not a rounding error. At 6.625%, the monthly payment on principal and interest is roughly $1,793. At 7.125%, it is roughly $1,886. $93 a month. $93 a month over 360 months is $33,480. That is the cost of the tier difference on the payment alone, but the total interest tells a different story. At 6.625%, total interest over 30 years is approximately $365,000. At 7.125%, it is approximately $399,000. The gap is roughly $34,000, paid in interest silently over 3 decades on the same house for the same loan amount for the same term. Not because of the house, not because of the neighborhood, not because of the lender, because of the tier. You initial the rate page. You sign the final document. The notary stamps the stack. The keys are yours. The 750 tier did not give you the house. You earned the house. The 750 tier gave you the rate. And the rate, compounded over 30 years, is worth more than most people understand when they are sitting at the closing table for the first time. 800. The score is above 800 now. You are not sure exactly when it crossed that line. There was no notification, no certificate. The number moved because the inputs held for long enough that the system recalibrated. You are at the municipal utility payment window. A new apartment. A new city. You need to open a utility account. The clerk types in your information. Runs the check. Looks at the screen. Standard deposit, she says. Accounts open. That is it. No hold on the first check. No deposit form. No 3-month buffer sitting in an account you cannot touch. The account is open. The service starts on the date you requested. The absence of a charge is itself the evidence. Here is what nobody tells you about the top tier. The reward is not a better rate, though the rates are better. The reward is not a lower premium, though the premiums are lower. The reward is the disappearance of friction. The application that goes through without a call. The account that opens without a form. The lease that does not generate an addendum. The loan that does not require a cosigner. The insurance renewal that does not arrive with an unexplained increase. The friction cost, the time, the documentation, the quiet specific exhaustion of being asked to prove yourself to a system that has already decided what tier you are in. That cost disappears before the rate difference even matters. At 800 plus, the system stops charging the premium. Not because you proved yourself, because the tier moved. What moves the tier? The score is not a mystery. It is a formula, and the formula has 2 inputs that do most of the work. The first is payment history. approximately 35% of the score. On-time payments build it. Late payments damage it. A single 30-day late payment can drop a score by 60 to 110 points, depending on where the score started. The damage is not permanent, but it is not fast to repair. The system weights recent behavior more than old behavior, but old behavior does not disappear immediately. The second is credit utilization, approximately 30% of the score. This is the ratio of what you owe on revolving accounts to what you are allowed to borrow. A card with a $5,000 limit carrying a $4,200 balance is at 84% utilization. The system reads that as pressure. A card with a $5,000 limit carrying a $900 balance is at 18% utilization. The system reads that as margin. The threshold that matters most is 30%. Staying below 30% utilization across all revolving accounts is the single most actionable lever most people have. It does not require new accounts. It does not require a perfect history. It requires the balance to stay below the threshold. These two inputs, payment history and utilization, account for roughly 65% of the score. The remaining 35% is length of credit history, credit mix, and new inquiries. Those move more slowly and are less immediately actionable. The tier does not move because you deserve it to move. It moves because the inputs moved. The system does not know your story. It does not know about the stretch period, the delayed payment during the month the transmission went, the card balance that never quite cleared because the income was inconsistent. It knows the inputs. It runs the formula. It assigns the tier. The tier is not a judgment. It is arithmetic. The leasing office again. Same counter. Same laminated floor plan on the window. Different number. The manager types in the application. The screen loads. She looks at it for a moment, then looks up. Standard deposit, she says. 1 month. You want to go over the lease terms? She does not turn to the copier. The addendum does not print. There is no line item to read, no $2,800 to absorb, no quiet specific moment of being handed a document that tells you what tier you are in. The machine ran the number. The number cleared the tier. The system that repriced you for years, on the deposit, on the auto loan, on the insurance renewal, on the mortgage rate, has simply stopped charging the premium. Not because you proved yourself. Not because you argued with the formula or explained the stretch period or demonstrated that the late payment was a single month in a difficult year. The system does not take explanations. It takes inputs. The inputs held. The tier moved. The addendum did not print. That is the whole mechanism. Not a grade. Not a reputation. A pricing tier that reprices every financial product you touch silently for as long as you are in it and stops the moment you are not. The balance is not a number on a screen. It is the aggregate cost of every tier you have ever occupied, compounded across every product that ran your number and returned your price. The system already ran your number. The price it returned is not the price. It is your price. Until it isn't.